All right, guys, real quick here, just to review on what we did yesterday on lesson 1-1, and the biggest takeaway was accounting equation. Assets equal liabilities plus owner's equity. It always has to equal. All right, before we go further into the next section here, I want to talk just real briefly about Techno Consulting. Techno Consulting is going to be the example that is used throughout the book, and a couple vocab words, and I'm going to try to point these out. I'm not going to point out every vocab word, but vocab is important. So it's up to you. You will be tested over it. And so I'm going to point some stuff out. So service business, Techno Consulting is a service business. Basically what they're doing is they're going to set up and troubleshoot computer networks. So that's what a service business does. You provide a service. This business is considered a proprietorship or a sole proprietorship because basically it's owned by one person. And it's a lady, and I can't remember the name of her right off the top of my head. So those are the biggest things to know about Techno Consulting, and that's going to be the business that the book uses as they go forward. The other thing are accounting concepts. There's 12 of these concepts that kind of form the backbone of accounting. And the first one is called business entity. It's when the business's financial information is recorded and reported separately from the owner's personal. So basically what they're saying is you start a business, your business is your business and your personal is your personal. You can't use your personal checking account to pay stuff for your business, and you can't use your business's checking account to pay stuff for your personal. All right, so they're two separate. The business is its own thing. It's separate from you as an individual. So make sure you're aware of that. So accounting concept, business entity. All right, so what we're going to be talking about today is how transactions change the accounting equation. All right, so that's what makes up a business, are transactions. When you buy stuff and you sell stuff, I mean, that's the whole idea. You want to make money. So we're going to talk about 4 different kinds of transactions today. You're going to receive cash from the owner investment. That obviously is going to be your very first one because you don't have any money. You go to the bank, you get your investment. That's going to be your first transaction. Then you need to pay cash for some things, all right? And we'll talk about that. Then we're going to buy supplies on account, and we're going to pay cash on account. And I'll talk about those when we get to those transactions. So those are the 4 transactions that we're going to kind of talk about. Another accounting concept pops up here, unit of measurement. Basically what this is saying is that when you start your business, you need to decide what your unit of measurement or / what money you're going to use. If you're in the United States, you're probably going to use dollars and cents, all right? And you can't change that. Once you start with that. If you're in the United States but you're doing business internationally, maybe you do euros or pesos, and I don't know all the other different monetary things. But basically, once you start, you stay with that. You can't change back and forth. So accounting concept, unit of measurement. All right, so I'm going to go through, and you can go back and look at these, but basically we have assets equals liabilities plus owner's equity. That accounting equation is always going to equal after every transaction. Now, the thing is that we don't just deal with assets, liabilities, and owner's equity. We actually have accounts that we're going to be talking about and introducing here. Each account is going to be either labeled as an asset, a liability, or an owner's equity. So our first 2 accounts are cash and Kim Park. That's the name of the owner, and it's going to be capital. Owner's equity is the account is called the owner's name plus capital. So if you on the 1st, we're going to be doing transactions, but technically we're doing dates. So August 1st, you receive cash from the owner as an investment for $5,000. So you've went from having 0 money in your account, so now we are increasing cash by $5,000, and we're going to come over here and we're going to increase owner's equity by $5,000. So now if you notice, this assets is considered the left hand of the left side of the accounting equation, and liabilities is considered the right hand side. So 5,000 equals 0 plus 5,000, 5,000. So the accounting equation equals. All right, now we're going to pay cash. we're going to be buying supplies, and we're going to be buying insurance. And the accounts are called supplies, and we call insurance prepaid insurance because we're prepaying for our protection. All right, and these are assets because if you remember, assets are things that we own. So we own cash, we own supplies, and we own our prepaid insurance. And then capital is under owner's equity because that's our financial right as an owner in our business, okay? So it says that you paid cash for supplies, $275. So if you pay cash, you're losing cash, but we're gaining supplies. So we subtracted cash, added supplies. So we went ahead and subtracted 275 from 5,000, came up with a new total. We have 0 plus 275. Put that in there. If you add those two numbers up, they're going to equal 5,000, and then we've got 0 plus 5,000. So our accounting equation still equals right there. All right, paid cash for insurance. So we are $1,200. So we're going to subtract out 1,200 because we're paying cash, we're losing cash, but we're gaining insurance. So again, we subtract out that, we come up with a new balance, we bring that balance down, and now we go from 0 to 1,200. So if you add those up, those three numbers are going to equal 5,000 equals 0 plus 5,000, 5,000. So the accounting equation still equals, and it always should after every transaction. All right, bought supplies on account. All right, so now we're talking about liabilities. And here's what a liability is. So sometimes when you're a business, this particular business is dealing in technology stuff. So you might have a particular place where you want to get a lot of your supplies from. And Techno is going to use Supply Depot as a place where they're going to get a lot of their supplies. So and a lot of times basically what businesses will do is I'll send in my order for the supplies that I want. That business, Supply Depot, will see what I want, then they'll ship it back to me, and they send me a bill at that time. And then once I get the bill, after I've gotten my stuff, then I pay it. But in accounting, you can't wait until you pay for your supplies to show that you got your supplies. So when we make this transaction, we know that we're gaining supplies when you buy supplies on account. So what we're doing here is we've got this liability. Liabilities are things that, it's basically money that we owe. So accounts payable is money we owe. So what we're going to do is we're going to say we're going to go ahead and show that we have supplies right now, that we bought supplies, but we're going to kind of put it over here in this holding account to show that we still owe $500. So again, you just bring down cash balance. We went from having this $275 of supplies, add 500, so now we're up to 775. We bring down our prepaid insurance. Now we went from owing 0, now we owe 500, and we have our capital. So again, if we add these two numbers up and those three numbers up, we should be 5,500. And then now once you buy on account, well, now you've got to pay your balance. Some businesses will pay it off right away, and for whatever reason, some will only pay part. If you're a new business, maybe she only could afford to pay part of her accounts payable, and that's fine. You can do that. So we paid the cash now. Up here we got our supplies, but we haven't paid any cash. Down here we're paying the cash, but we didn't pay it all, so we have to show a decrease, but we still owe 200. So we subtracted out cash. We still have this amount in supplies. We have this amount in prepaid insurance. Now we went from owing 500, now we still owe 200, and that. Again, if we add up these numbers and these numbers, our accounting equation would equal. All right, so really quick about our transactions. So hopefully this is making sense. And if not, you can always email me and I'll help you out. But basically then, some rules. So basically the rule is what you do to one side of the equation, you have to do to the other. So I said assets is considered the left-hand side of the equation. Liabilities and owner's equity is considered the right hand. So if you increase the left-hand side, you have to increase the right-hand side. If you decrease the left side, you have to decrease the right side, okay? Here's another rule. If the transaction affects only one side of the equation, then one of the accounts has to be increased and the other account has to be decreased, and I'll show you that. And then lastly, the accounting equation must always remain in balance. And I guess I should have put in here, and I can't remember if I said it or not, there's always going to be two accounts used. You're always going to have two accounts that are affected for each transaction. All right, so here's a little cheat sheet that you can look back on, and I put the different transactions and kind of what happened. So here's the rule. Bought supplies on account. So I'm increasing supplies, which is an asset, and I'm increasing accounts payable, which is a liability. So since I increased it on the left-hand side, which is assets, I have to increase over here. Received cash from the owner as an investment. Same thing. I'm increasing cash, increasing owner's equity. I increased this side, I have to increase this side. Here's paid cash for insurance. All right, insurance, prepaid insurance, and cash are both assets. So here's the rule if both accounts are on the same side of the accounting equation. One has to be increased, and one has to be decreased. All right, so there's that rule, because if you don't do this, the accounting equation won't equal. And then the last one is, again, we paid cash on account. All right. I'm losing cash, which is an asset, and we're paying on account, which is a liability, and this is on the left-hand side, this is on the right-hand side, so if I do a decrease on this side, I have to do a decrease on this side. All right, so that's really fast what we're doing, so feel free to look back at this. Also, if you have questions, you can email me. All right, so super quick, this is going to be your assignment. You're going to make a copy of this so that you can actually do it. Your transactions you're going to look at are on page 19 and 20 of your textbook. I did the first two for you. The first one is that you received cash from the owner as an investment. So again, you start with 0, and then you do your transaction, and I would actually do the plus or the minus just so you know what's going on. So we received $300,000 in cash, and I'm going to put that in my capital. So I'm going to bring down my new balances. So I've got 3,000, these balances haven't changed, and now I've got 3,000, and my accounting equation equals. This one, the second transaction is that we paid cash for insurance. I'm losing $1,600, but I'm gaining $1,600 in prepaid insurance. And so I bring down my new balance, and it's $1,400, and then 0, $1,600, and then 0, 0, 3,000. So 3,000 equals 3,000. My accounting equation equals. What I want you guys to do is make a copy of this and continue on doing the rest of the transactions, and when you get down here to the bottom, your assets should equal your liabilities plus owner's equity. If they don't and you don't know why, don't hesitate to check with me, and I'll see if I can figure out what happened. All right, so that's pretty fast explanation. Hopefully this makes sense. If there's something that's not making sense, make sure you get a hold of me.